Thanks for tuning in to this month's market update video for the month of March. As of the day of recording here, April 3rd, 2025, one day after President Trump's Liberation Day announcement yesterday, April 2nd, about global reciprocal tariffs, we are seeing global stock markets sell off. The US S&P 500 is having its worst day since 2020 as investors react quite negatively to the reciprocal tariffs that the administration in the United States has announced. Since Trump's inauguration in January, US stocks now lag the global markets by the most since 2009. And the US dollar has depreciated significantly today as well, April 3rd.
So in March, the S&P 500 was down 5.75%. Conversely, the Canadian market fared better, still negative, but it was only down 1.87% in March. Over the past 12 months, the Canadian stock market has grown by 10.3%, outpacing the S&P 500, which grew at 5%. Now, typically, the US market has performed exceptionally over the past decade or so, outpacing global markets. But the announcement yesterday with Trump and all the tariffs that are happening right now does create a lot of uncertainty. We're seeing US stockholders dumping US stocks in favor of global markets as they anticipate a potential US recession later this year.
So amid all the chaos and uncertainty resulting from these tariffs, is there any silver lining for investors? The good news is that there is, or has been, for diversified investors like many of our clients who do own some bonds and have exposure to international markets, including Canadian stocks, European stocks. Diversified portfolios have fared quite a bit better than an all US equity portfolio over the past 3 months, certainly as US markets have lagged. In fact, Q1 of 2025 is the first 3-month period since 2020 at the beginning of the COVID pandemic that bonds have actually risen while stocks have gone down. So diversification is working once again, which, while it doesn't completely mitigate the losses for most client portfolios due to stock market losses, it does help blunt that volatility, which is the primary reason why many investors own bonds in the first place. So going forward, Kevin, what should we expect for the economy due to these tariffs?
On a macroeconomic level, this will cause inflationary pressures as tariffs are a tax on imported goods, so the price of products will start to go up. We're about to see pressures on employment, not just in the US, but globally, as businesses try to insulate profits for their companies by possibly laying off employees, as we are starting to see some major companies do. We're also going to see businesses really struggle to come up with concrete plans looking forward. They're going to have a lot of concerns about how markets are going to react, how consumers are going to react to all of this, and trying to figure out what they do, if anything, at the moment on a go-forward basis. We anticipate that many companies will kind of sit on their hands for at least the first little bit to try to see how this plays out before they start putting any of their capital to work growing their companies.
We're likely to see continued volatility over the next weeks as investors and markets continue to unpackage what these reciprocal tariffs mean and digest what the economic impacts are going to be. Now, we understand amidst all this uncertainty and fear and panic that many investors logically know that this may be bad for the economy and may want to have a reaction to it. They may want to do something to protect their portfolio, protect their investments from any further deterioration. Now, of course, this is an absolutely logical response that we certainly understand, but we don't recommend making any drastic changes at this point in time. The reason being is that while the tariffs seem to be going forward, The rollout of the tariff plan has been very haphazard, has been very blurry and confused. And so we don't actually know if these tariffs are going to proceed at the rates that they've been first disclosed yesterday at Trump's media announcement. Also, there is some pushback from other Republican party members. Certain senators from certain states. Rand Paul from Kentucky has been one of the most outspoken Republican senators dissenting these tariffs. And so we're starting to see some more rhetoric from some of these senators pushing back against the Republican Party and Trump's administration's planned tariffs. So we just don't know right now, obviously, if the tariffs at the current rates are put on for any length of time, it will cause economic damage to the United States and other economies globally too. The question being, of course, how bad could it be? But the other side of that coin as well is that the tariffs may be knocked back. I think that's even quite likely. Canada and Mexico were largely unaddressed yesterday outside of the global auto tariff, obviously going to impact Canada and Mexico to some degree, as well as the pre-existing tariffs that were already on. But no additional tariff was levied against Canada and Mexico yesterday due to the US-Mexico-Canada trade agreement that Trump actually somewhat honored yesterday. So it will be interesting to see in the coming weeks how things unfold. But again, we don't recommend that clients make any dramatic changes to their portfolio during these periods of heightened volatility.
It's a very good point, David. And actually, whenever we see equity market performance start to lag, it's typically for a good reason. It means something bad is happening in the world and the markets are reacting in real time. And this type of action can often be viewed by some investors as requiring a reaction. And it's not always a very prudent way to handle your investments. While reacting may seem like a logical response and even offer some short-term psychological relief, meaning you got out of the market, you're sitting in cash, you now no longer have to worry about what's going on in the world. Making drastic wholesale changes to your investments during heightened periods of volatility often causes the worst performance in the medium to long-term scenario. If you take a look at the chart on your screen, this shows the calendar year returns for the S&P 500 going back to 2000. And then also shows the calendar year returns had an investor missed the 10 best days of that year. In aggregate, the S&P has returned, on average, annualized returns of 9.4% over this nearly 25-year period. Having missed the 10 best days in each of those years reduces the average annualized return all the way to negative 14.1%. 3/4 of the calendar years since the turn of the millennium have produced positive returns, had you remain invested. Missing the 10 best days each year reduces this to only 24% of the years having been positive. When you try and time the market by moving to cash, even if only temporarily, you risk missing some of those 10 best days of the year. The reason being is that most of the best days tend to cluster and come in short succession after the worst days. If you are in cash for a month or two just to see how things will unfold, you will inevitably also be in cash when the markets experience some of their biggest bounces off lows.
Exiting the market and being in cash for when some of those best 10 days inevitably happen during a calendar year is what can kill long-term investment returns. The moral of the story is to not overreact to one bad day in the market or even a bad month or bad year. Staying invested and getting past the difficult patches that come with being an equity investor is part of the deal. The price of admission to higher returns in the long run is dealing with some crummy days and even crummy weeks or months, or like we said, even negative years from time to time. In fact, if we rewind just shortly back to 2022, That was a poor year for many clients, investors globally, right? Most people had negative returns in 2022. But if you stuck with it, if you didn't bail on the markets and go to GICs in 2022, you were rewarded nicely with handsome returns in 2023 and 2024. Now, here we are in 2025 going through another period of volatility. This time, another valid reason to be worried about what the future holds. But nevertheless, markets will respond. Companies will figure out a way to remain as profitable as possible, even if tariffs are on. But like we said, there's always two sides to every coin. And that while the tariffs appear to be problematic and certainly would be if they're on for any length of time, we do have reason to believe that they may be softened. In some cases, maybe they'll be eliminated entirely as constituents in the United States, business leaders in the United States, investors in the United States, and lawmakers in the United States dissent against these tariffs that Trump has proceeded with. So try and be patient. Again, if you are worried, we certainly understand that. We're here to take your calls. We're here to review your portfolio with you, explain, how you're positioned, and if necessary, make little adjustments around the margins. But like we've said many times during this video, we don't recommend making drastic changes, especially after a really poor day like we're having today on April 3rd.
Yeah. Feel free to reach out to Harry, David, or myself at any time. We're happy to take your call. Take care.